You're listening to the Shaughnessy Group podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
Imagine, for just a second, that you own a business. Like you've poured your blood, sweat, and tears into this company for years.
Yeah, completely build it from the ground up.
Exactly.
Yeah.
And you're finally reporting $10 million in EBITDA. You go to the negotiating table, you manage to secure a 6x multiple from a buyer, and you're expecting this massive $60 million payday.
Which is life-changing money for anybody, really.
Oh, absolutely. You're already picturing the next chapter of your life, right?
Yeah.
But then during due diligence, the buyer's team finds $2 million in what they call non-recurring items.
And that is where the nightmare starts.
Right. Suddenly, your adjusted EBITDA isn't $10 million anymore, it's $8 million. And here's the brutal reality of the math. For every single dollar the buyer's accountants remove from your earnings, you don't just lose a dollar.
Because of that 6x multiple.
Because of the multiple, exactly. You lose $6 off your final sale price. So just like that, with a few strokes of an accountant's pen, you lost $12 million.
It is an absolute gut punch, and it happens all the time. It's terrifying. And that massive, gut-wrenching swing is exactly what we are unpacking today. So thank you so much for joining us for this deep dive, because our mission here really is to make sure you never find yourself on the losing end of that equation.
Yeah, it's a brutal scenario, and it hinges entirely on that acronym you just mentioned, EBITDA. Earnings before interest, taxes, depreciation, and amortization.
Right.
Buyers use EBITDA because it strips away the current owner's specific tax strategies or their capital structure. It's meant to show the pure, bare-bones, cash-generating engine of the business.
Sort of leveling the playing field in a way.
Exactly. But the problem is that a buyer and a seller rarely agree on how powerful that engine actually is. I mean, the seller is looking at the absolute best-case scenario.
Naturally.
Yeah, well, the buyer is looking for every possible reason to discount it. And that tension is the reality of middle-market mergers and acquisitions, specifically for Canadian business owners with revenues sitting somewhere between, say, $5 million and $50 million. And the battlefield where that tension really plays out is this document called the Quality of Earnings Report, or QOE for short.
QOE, yeah.
And we are going to explain this absolute beast of an M&A document in clear, simple layman's terms today. Because if I'm a business owner, right, and I have an official auditor who has stamped my books every single year and said my financials are completely accurate.
Right, your CPA says you're good to go.
Yeah. Why is my valuation still at risk? Like, why isn't an audit enough to protect that $12 million?
Well, it really comes down to the fundamentally different purpose of the two documents, because an audit simply checks if your financial statements comply with generally accepted accounting principles, or GAAP.
Okay, so it's a compliance thing.
Exactly. It's a rigid compliance exercise. The auditor is basically just asking, did you record things in the correct columns according to the legal rules?
Did you do the math right?
Essentially. Yeah. A QOE, however, analyzes the true economic reality of the business. It normalizes your financial results by stripping away all those unusual, non-recurring items. So an audit cares about the rules, but a QOE cares about reality.
Wow. Okay.
It focuses heavily on your adjusted EBITDA, the actual sustainability of your margins, and whether your cash flow actually matches your reported revenue.
Okay, let's unpack this with an analogy. If selling your business is like selling a house, an audit is just the home inspector checking if the plumbing is legally up to code.
Yeah, making sure the pipes are where they should be.
Right. But the QOE, that's the buyer checking to see if the entire neighborhood is sinking into a sinkhole and like if your electric bill is actually sustainably affordable month to month.
That is a perfect way to look at it. The buyer isn't just looking at the structure, they are evaluating the future performance of that structure.
Because they're the ones who have to live in it.
Exactly. And to do that, the QOE team doesn't just glance at your year-end tax returns. They pull monthly financial data over the last 3 fiscal years, plus the trailing 12 months period.
The TTM.
Right. They are literally tearing the business down to the studs to see how it performs across time. They're looking for seasonal anomalies, one-time spikes in revenue, or, hidden operational costs. They want to know exactly what the business will look like the day after they take over.
Okay, so if the buyer is going to tear my business down to the studs anyway, this brings up a massive point of friction that I saw in the sources.
Okay, what's that?
We know buyers always commission a buy-side QOE report right after the letter of intent, the LOI, is signed. They need validation. Their lenders require it to approve the financing. and they obviously use it for negotiating leverage.
Oh, absolutely. They always do.
Knowing all that,
Wired.
our sources talk about a sell-side QOE, commissioned by the owner before going to market, and it costs tens of thousands of dollars, sometimes 50 to 100 grand.
It is not cheap.
Right. So if I pay for that out of pocket and my deal falls through because, I don't know, the market shifts or the buyer gets cold feet, I'm just out 100 grand. How do you justify that massive sunk cost to an owner? Aren't I just doing the buyer's homework for them and wasting my money?
I hear that pushback all the time. That upfront cost is a bitter pill to swallow. But you have to look at the alternative. If you don't do a sell-side QOE, you are letting the buyer's accounting firm completely dictate the narrative of your company.
Oh, I see.
And remember, the buyer's team is financially incentivized to find negative adjustments to your EBITDA. By conducting a sell-side QOE like 6 to 12 months before you even try to sell, you identify the red flags before the buyer's team ever sees them.
So you find the sinking foundation before the buyer's inspector shows up.
Exactly. You get ahead of it.
So you're basically paying to control the story. Like, if there's an ugly quarter in my financials because of a weird supply chain issue, I want my advisors to frame that story with context rather than leaving the buyer's accountants to just assume the worst and slash my valuation.
Yes, controlling the narrative is huge. But beyond that, it drastically accelerates the transaction timeline.
How much time are we talking?
Our sources estimate that having a sell-side QOE ready can save 1 to 2 months in the closing period.
Wow, 2 months is an eternity in a deal.
It really is. You hand the buyer a pristine, third-party verified report right out of the gate. I mean, they will still do their own checks, of course, but their work is reduced to simply verifying your data rather than discovering it all from scratch. You set the baseline with a high-quality, defensible earnings number.
Okay, so let's get into the mechanics of what these advisors are actually looking for. If I'm spending that money to do this 6 months early, what exactly am I paying these advisors to find?
The hidden landmines, basically.
Right, like if I look at my books right now, what's going to make a QOE team slam on the brakes?
Well, the scrutiny usually starts with revenue quality and sustainability. They're going to look really closely at customer and vendor concentrations.
Meaning relying too much on one person.
Exactly. If 50% of your revenue comes from one single client, or say you rely entirely on one supplier in Asia for your core materials, that is a massive risk.
Because if they leave, you're toast.
Right. If that supplier goes bankrupt or that key client just decides to leave, the whole business collapses. A buyer will penalize that heavily, often by structuring an earnout where you only get your full payout if that key client stays for 2 years after the sale.
Oh, wow. So you don't even get your money up front.
Nope. It stays tied up.
The next big red flag I saw in our research is the mix of cash and accrual accounting. Why does that specifically destroy valuation?
Because it artificially distorts your profit margins.
How so?
Well, if you record your sales on an accrual basis, meaning you count the money as revenue the very moment the invoice is sent out,
Right.
but you track your expenses on a cash basis, meaning you only count them when the bill is actually paid from your bank account, you create this massive misleading gap.
Oh, I see where this is going.
Yeah, in a month where you send out $1 million in invoices, but you deliberately hold off on paying your suppliers, your profit looks astronomical on paper.
Right, but it's not real.
Exactly. Buyers see that mismatch and instantly assume you are artificially inflating your margins to secure a higher multiple. The QOE team will rebuild your financials entirely on an accrual basis to see what the true margins actually are.
That makes total sense. Now, I was looking through our notes on these red flags, and I saw this fascinating concept of recurring one-time expenses.
Oh, yes.
And I just had to laugh when I read it because it's such an oxymoron. It's like me saying, I only eat junk food on special occasions, but then I have a special occasion every 3 days.
Right, exactly.
Oh, it's Tuesday, let's get pizza. Oh, it's raining, let's get donuts.
It's funny, but that's exactly how it happens in business. The buyer's team looks at that exact pattern and says, look, this isn't a series of anomalies. Business owners often try to artificially inflate their normalized earnings by adding back unusual expenses.
Oh, I've heard of this, the add backs.
Yeah. They'll tell the buyer, hey, add back this $50,000 legal fee. That was just a one-time lawsuit. Or add back this $80,000 consulting fee. That was a one-off project.
But the QOE team sees the pattern.
Right. If the QOE team sees a new lawsuit one year, a massive consulting project the next, and an unusual marketing push the next, they will conclude that these are just regular operating costs for your specific industry.
They aren't one-offs at all.
Exactly. And they will wipe those add backs out entirely.
Which slashes the EBITDA, which triggers that 6x multiplier effect we talked about, which destroys the valuation.
Yep, it all cascades down. And there is a real-world example of this in the text. A middle market deal that seemed incredibly solid on the surface. The LOI was signed, everyone was happy.
But then the QOE happened.
Right. The buyer's QOE uncovered a messy mix of that exact cash and accrual accounting we just discussed. Plus, the seller had overstated assets and was missing crucial paperwork to actually back up their revenue claims.
Oh no, so they couldn't even prove the numbers.
No, they couldn't. The seller had to defend their original valuation with shaky, unverified numbers, and when that happens, the trust just evaporates. The valuation plummeted, and the deal nearly fell apart entirely, just because they didn't clean up their own house first.
So let's say I'm listening to this and I'm thinking, okay, my EBITDA is squeaky clean. I don't play games with ad backs, my customer base is highly diversified, and my accounting is absolutely flawless. I'm safe.
Right?
You know?
You would think so?
Well, apparently not, because there is a completely different mechanism that causes some of the most bitter day of closing disputes imaginable, and that is working capital.
Yes. Working capital is, it's honestly one of the most misunderstood concepts by founders, and it absolutely torpedoes deals at the finish line.
So what is it exactly?
In financial terms, working capital is just your current assets minus your current liabilities. It's the everyday liquidity, like the cash tied up in inventory and accounts receivable that you need to keep the lights on and pay your staff before your customers actually pay you.
Okay, so it's the operational cash. But why does this blow up an M&A deal if the multiple and the EBITDA are already agreed upon? Like, if we agreed on $60 million, why are we fighting over everyday cash?
Because almost all middle market deals are structured to be cash-free, debt-free.
Cash-free, debt-free.
Yeah.
Okay, what does that mean in practice?
This means the buyer takes over the business operations, but the seller gets to sweep the excess cash from the bank accounts on closing day.
Nice. I take my cash.
Right. And in exchange, the seller pays off any long-term company debt. However, the seller must leave a targeted amount of working capital in the business at the exact moment of closing. If there's negative net working capital, it creates major liquidity concerns. The buyer refuses to buy a business on a Friday and then have to inject $500,000 of their own cash on a Monday just to make payroll.
Okay, I think I get it. So if I'm selling you my car, the cash-free, debt-free structure means I get to take all my loose change out of the cup holder and I have to pay off my own auto loan at the bank.
Yes, perfect analogy.
But the working capital target means I still have to leave enough gas in the tank for you to actually drive it off the lot. You aren't going to buy my car if you have to push it to the nearest gas station.
Exactly. You have to leave enough gas in the tank. And in financial terms, that gas target is a pegged number negotiated in the LOI.
Okay.
Let's say the target is pegged at $1.5 million in working capital. If on closing day, you only have $1.3 million left in working capital because you, say, aggressively collected receivables and paid off your vendors early.
You have a $200,000 shortfall.
Right. And that $200,000 is deducted dollar for dollar from your final wire transfer.
Ouch. So how is that initial target calculated? Like, who decides what constitutes a full tank of gas?
Well, the QOE analysis determines it. They look at an average or a percentage of your revenue over a trailing 3, 6, or 12-month period.
So it fluctuates.
It has to, because it has to account for seasonality. I mean, if you sell a landscaping business in November, your working capital needs are vastly different than if you sell it in May.
Right, that makes sense.
And here is the kicker. If you haven't done your own sell-side QOE, the buyer's team gets to calculate that target. They will manipulate the historical average period to demand you leave way more gas in the tank, which directly reduces the cash you take home at closing.
That is wild. You could survive the entire EBITDA negotiation, keep your multiple perfectly intact, and still lose hundreds of thousands of dollars at the closing table simply because you let the buyer dictate the working capital calculation.
It's a hidden trap door. It catches incredibly smart founders off guard every single day.
Wow. Okay, so understanding these pitfalls theoretically is one thing, but practically speaking, this sounds like an absolute nightmare.
It is exhausting.
A QOE takes, what, 3 to 4 weeks of intense scrutiny?
Minimum, yeah.
Your management team is trying to hit their quarterly targets to keep the valuation up, while simultaneously spending 20 hours a week in a data room being cross-examined by a Big Four accounting firm. Like, the burnout risk during a QOE has to be a massive, unspoken threat to the deal.
It absolutely is. The QOE process stresses the entire organization to its breaking point, which is why preparation is everything. We need to break down the roadmap for the three key groups involved.
Okay, let's go through them.
Starting with the seller. The owner expecting the big payday, they must organize everything up front. Tax returns, bank statements, loan agreements.
Everything has to be ready to go.
Everything. Any skeletons in the closet, any pending litigation, any handshake deals with old suppliers, they need to pull them out and address them transparently on day one. Hiding things creates delays, and delays destroy trust.
And then there's the management team, the people running the day-to-day operations while the owner is focused on the exit.
They honestly bear the heaviest burden. Once the initial data is uploaded to a secure virtual room, the management team must prepare for grueling Q&A meetings with the QOE advisors.
Grueling, like how long are we talking?
These meetings can last for 2 full days, just back-to-back questions. Management has to be ready to explain the granular mechanics of the business.
So they can't just be high level.
No, not at all. If the advisors ask, hey, why did shipping costs spike in October of last year? Management cannot say, I'll have to get back to you on that. They have to know the operational numbers cold. Because if the management team looks incompetent, the buyer's confidence in the future of the business just plummets.
That sounds incredibly stressful. Finally, you have the accounting function, the internal bookkeepers and controllers.
Yeah, they are on the front lines of the data requests. They must ensure the books are GAAP compliant to begin with. They have to reconcile every single account so there are no unexplained variances.
Everything has to tie out perfectly.
Exactly. And crucially, they need to have source documents ready for every single one of those EBITDA add-backs we talked about earlier.
Oh, right, the junk food add-backs.
Right. If you tell the buyer an expense was a one-time legal fee, your accounting team better have the original invoice and the cleared check ready to upload immediately.
Which brings up a quote from the sources that I think summarizes the urgency of this entire process. Time kills deals.
It is the truest statement in M&A.
Once that LOI is signed, the clock is ticking. Most buyers won't even engage their expensive corporate lawyers to start drafting the final closing documents until the QOE is finished.
Right, because why would a buyer spend $50,000 on legal fees if the QOE might uncover a fatal flaw in the customer concentration? They just wait.
The whole deal goes into a holding pattern.
Yep. If your accounting team takes 2 weeks to find a missing invoice, that's 2 weeks. The deal is completely stalled. And every single day a deal is stalled is a chance for macroeconomic conditions to shift, for interest rates to rise, or for the buyer to simply get cold feet and walk away.
So let's bring all these threads together for you listening. If you are running a Canadian business generating between $5 and $50 million in revenue, a quality of earnings report is absolutely non-negotiable.
100%.
The buyer will commission one. The only question is whether you're going to be proactive, absorb the upfront cost, and commission your own sell-side QOE first. Doing so allows you to control the narrative, defend your adjusted EBITDA against that ruthless multiplier effect, and mathematically protect your working capital at closing.
Because in the high-stakes world of M&A, the quality of your earnings matters far more than just the sheer quantity of those earnings.
So well said.
It is the ultimate defensive shield that honestly doubles as an offensive weapon during negotiations.
Amazing. We really want to thank you, the listener, for taking the time to learn with us today. Navigating an exit is one of the most stressful things a founder will ever do. Surviving the data rooms, the accountants, and the negotiations is a monumental task. But having this foundational knowledge is the first step to protecting your life's work. We also want to send a huge thank you to the Shaughnessy Group for providing these incredible insights and the source material for today's discussion. If you want to dive deeper and find more resources to prepare your business for a sale, visit their website at shaughnessy.group. That's just shaughnessy.group.
And if an exit is anywhere on your horizon, you should absolutely check out the companion book available on Amazon. You can find it directly at https://www.amazon.cad/pbb0gfxwjvxq. It goes into the deep mechanical details of everything we've covered today.
It's practically required reading if you want to keep that $12 million we talked about at the beginning. We'll leave you with this final thought to mull over. We spend our whole lives trying to build a valuable business. We track the sales, we celebrate the revenue milestones, we watch the bank account grow. But at the finish line, true enterprise value isn't just about what your business actually makes. It's about what you can undeniably prove under a microscope. What hidden story are your numbers telling right now, and who is going to read it first? You or your buyer?
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.